Japan's market crash in 1990 was caused by the bursting of a massive asset price bubble driven by a combination of loose monetary policy, excessive bank lending, and rampant real estate speculation. The subsequent failure to deal with the aftermath proactively led to an extended period of economic stagnation known as the Lost Decades. History and causes of the crash. In the 1980s, Japan experienced a significant economic boom, characterized by soaring stock and land prices. The primary factors contributing to this bubble were loose monetary policy, following the 1985 Plaza Accord, which caused the yen to appreciate. The Bank of Japan, BOJ, implemented low interest rates to stimulate the economy. This easy money policy encouraged excessive borrowing and speculation in the stock and real estate markets. Excessive lending and speculation, with easy access to credit. Both individuals and corporations took on massive loans, often using overvalued land as collateral, to invest further in assets. This created a feedback loop that pushed asset values to extreme, unsustainable levels. At one point, the land value of the Tokyo Imperial Palace was estimated to be worth more than all the real estate in California. Bank deregulation and weak governance. Financial deregulation allowed banks to pursue riskier lending practices, and a lack of corporate governance meant that companies were heavily invested in the stock market, making the system vulnerable to a downturn. The bubble began to burst in late 1989 when the BOJ, concerned about inflation and runaway asset prices, began a sharp series of interest rate hikes. Stock prices were the first to collapse, with the Nikkei index losing over 40% of its value in 1990 alone, followed by a precipitous decline in land prices that lasted for a decade. From history to modern times, the Lost Decades, the crash ushered in a prolonged period of economic stagnation and deflation, which is often referred to as the Lost Decade, lost 20 years, or even lost 30 years, as the effects have lingered for decades. Debt crisis and zombie banks. As asset values plummeted, borrowers were saddled with immense debt that they couldn't repay. Banks, slow to recognize their losses and restructure balance sheets, continued to inject funds into unprofitable zombie firms to keep them afloat, which hindered overall economic recovery. Deflation and stagnant demand. The downturn led to a lack of consumer and business confidence, resulting in reduced spending and investment. This created a deflationary spiral where prices stagnated or decreased, making the accumulated debt even harder to service. Government response and structural issues. While the government engaged in massive deficit spending and the BOJ maintained near-zero interest rates for years, a liquidity trap, these measures struggled to stimulate demand effectively. Underlying structural issues, such as an aging population and a reluctance to implement deep reforms, also contributed to the persistent sluggish growth. In modern times, Japan's economy has stabilized but has struggled to return to the high growth rates of the pre-bubble era, with nominal GDP actually falling between 1995 and 2025. The lessons from Japan's experience have served as a potent warning to other economies about the dangers of asset bubbles and the challenges of managing their aftermath.